Imagine this for a second. You check your credit score one morning and notice something strange. Yesterday, everything looked normal. Today, your score suddenly dropped by more than 20 points. You didn't miss a payment. You didn't take out a new loan. In fact, you even paid your credit card bill in full. Logically, your score should improve, not fall. Yet the system says otherwise. Situations like this confuse a lot of people. Responsible borrowers often feel like they are being punished for doing the right thing. They pay their bills on time, avoid interest, and keep money in their bank accounts. Still, their credit score moves in the opposite direction. It almost feels like the financial system is playing by rules nobody explained. Let's walk through a simple example. Suppose you own a credit card with a limit of $5,000. One weekend you decide to buy a new couch and a few items for your living room. The total purchase comes out to $2,000. It's a big purchase, but it isn't a problem because you already have the cash saved. A few weeks later, the statement arrives, and you immediately pay the full amount. No late fees, no interest, everything handled perfectly. But then something unexpected happens. A few days later, your credit monitoring app sends a notification. Your score just dropped. The confusing part is that nothing irresponsible actually happened. You used your credit card normally and paid it back exactly as banks recommend. This is where many people misunderstand how credit scoring actually works. Most of us believe the system watches our finances in real time. We assume that the moment we pay off a balance, the credit bureaus instantly update our profile. But the truth is far less immediate. The credit system doesn't operate like a live video stream. Instead, it behaves more like a camera that takes occasional snapshots. And unfortunately, that snapshot is often taken at the worst possible moment. To understand why this happens, you need to picture how a credit card billing cycle actually works. Every card operates on a repeating timeline that usually lasts about 30 days. During this period, you make purchases like groceries, fuel, online shopping, or dinners out. Each transaction slowly adds to your running balance. At the end of that cycle, the bank closes the billing period and creates what is called a statement. This document is the official summary of everything that happened during those 30 days. It lists your total balance, the minimum payment required, and the due date for the bill. Most people believe the due date is the most important moment in this process, but that assumption is where the misunderstanding begins. The day that really matters is the moment the statement closes. When the cycle ends and the statement is generated, the bank records the balance that exists at that exact time. That number becomes the figure they report to the credit bureaus. In other words, the system captures a snapshot of your debt before you even think about paying it. Imagine your billing cycle runs from the first day of the month until the 30th. Throughout the month, you use your card normally, and the balance slowly grows. By the time the 30th arrives, maybe the balance has reached $3,000. As soon as the statement closes, that $3,000 balance becomes the official data sent to the credit reporting agencies. Here is the surprising part. Your actual payment might not be due until 3 weeks later. Even if you pay the entire balance during that time, the credit report still shows the higher number that existed when the statement closed. This delay creates a strange disconnect between what you see and what the credit system sees. From your perspective, everything looks responsible. Money leaves your bank account, the card balance returns to zero, and you move on with your month. But the credit bureaus are not watching those updates in real time. They are looking at the single number that was reported when the statement closed. So if your balance happened to be high on that day, the report may suggest that you are using a large portion of your credit limit. Even though you paid it off soon after, the snapshot already captured the higher figure. For the scoring model, that temporary balance becomes part of your financial profile for the entire reporting period. Many people become frustrated when they see this happen. They start thinking the system is unfair or that credit cards are designed to trap users. Some even stop using their cards altogether because they believe every purchase might hurt their score. In reality, the issue usually comes down to timing rather than spending behavior. Credit scoring models pay close attention to something called credit utilization. This is simply the percentage of your available credit that you are currently using. If your card limit is $5,000 and your reported balance is $2,500, your utilization rate would be 50%. From the perspective of the algorithm, high utilization can signal financial stress. Historically, people who rely heavily on their available credit are more likely to struggle with repayment. Because of that pattern, the scoring system reacts quickly whenever utilization rises above certain levels. This is why understanding utilization can make such a dramatic difference in your credit score. Most scoring models treat it as one of the most powerful factors in the entire formula. Payment history may carry the largest weight, but utilization is usually right behind it. In simple terms, the system constantly asks one question: how much of your available credit are you using right now? The calculation itself is straightforward. You take the balance that is reported and divide it by the total credit limit on that card. The result is your utilization percentage. For example, if your card has a limit of $1,000 and the statement shows a $500 balance, that means you are using 50% of your credit. The numbers may seem harmless, but the scoring models react strongly once certain thresholds are crossed. When utilization climbs above roughly 30%, many algorithms start treating the account as slightly risky. Cross the 50% level and the signal becomes even stronger. If the balance approaches the full limit, the model may interpret it as a warning sign that the borrower is under financial pressure. What surprises many people is how quickly this change can affect their score. A person with an excellent credit profile can see their score fall noticeably within a single reporting cycle simply because a card balance briefly crossed one of those limits. No missed payments, no new debt, just a high balance captured at the wrong time. This explains why someone might pay their bill perfectly and still notice their score dip. The system did not evaluate the payment itself. It reacted to the balance that existed when the snapshot was taken. The good news is that utilization behaves very differently from other credit factors. Some mistakes in the credit world can stay on your report for years. A missed payment, for example, may affect your profile for a long time. Utilization, however, works almost like a reset button every month. Most common scoring models only look at the most recently reported balances. Once a new statement is sent to the credit bureaus, the previous numbers are basically replaced. That means if your utilization was high last month, but much lower this month, the system quickly adjusts your score to reflect the new situation. Because of this, utilization is often considered the fastest lever you can pull to influence your credit score. If you understand how the reporting cycle works, you can sometimes see noticeable changes in as little as one billing period. This brings us to an important strategy that experienced credit users rely on. Instead of waiting for the statement to arrive before making a payment, they reduce their balance before the statement is even created. By doing this, they control what number ends up on the report. Think back to the earlier example. If your balance is sitting at $800 a few days before the billing cycle closes, you could make a payment that reduces it dramatically. By the time the statement is generated, the remaining balance might be only a few dollars. That tiny amount becomes the official figure reported to the credit bureaus. From the outside, it now looks like you barely used your credit at all, even though you used the card normally throughout the month. At this point, many people come to a very simple conclusion. If low utilization helps your score, then reporting a balance of zero every month must be the perfect strategy. On the surface, that sounds logical. After all, owing nothing seems like the safest financial position. However, credit scoring models do not always interpret zero balances the way people expect. The system is designed to evaluate how someone manages credit, not just whether they avoid it completely. When every card on a report shows a balance of zero month after month, the algorithm receives very little information about how that person handles borrowing. In other words, the system cannot clearly see you using credit and paying it back. To the model, it may appear as if the accounts are inactive or barely used. While this situation is not harmful in the way high utilization is, It also does not generate the strongest possible score. Data from high-scoring profiles shows an interesting pattern. Many people with top-tier credit scores still allow a very small balance to appear on their statements. The balance is tiny compared to their credit limit, but it proves to the system that the accounts are active and being managed responsibly. This creates a small but important signal. It shows that credit is being used, yet the amounts remain extremely controlled. The model reads this behavior as a sign of discipline rather than avoidance. As a result, the scoring formula often rewards this pattern slightly more than a report filled entirely with zeros. Because of this behavior in the scoring models, many experienced credit users follow a simple strategy. Instead of letting every card report as zero balance, they allow one card to show a very small amount while the rest report nothing. This approach keeps the report active while still maintaining extremely low utilization. Imagine someone who owns 5 credit cards. A few days before each statement closes, they review the balances. 4 of the cards are paid down completely, so the statements show zero. On the 5th card, they leave a tiny balance, maybe $10 or $20 depending on the credit limit. When the statements are generated, the report now shows one active account with a very small balance and several other accounts with none at all. From the perspective of the scoring algorithm, this pattern looks ideal. It proves the person is using credit but not relying on it heavily. The important thing to understand here is the difference between reporting a balance and carrying a balance. These two ideas sound similar, but they are not the same. Reporting a balance simply means a small amount appears on the statement that gets sent to the credit bureaus. Carrying a balance, on the other hand, means leaving that amount unpaid past the due date and being charged interest. As long as the reported balance is paid before the due date arrives, no interest is added. This allows someone to show activity on their credit report while still avoiding any extra cost. Once you understand this timing, managing utilization becomes much more practical. The key is to focus on the days before the statement closes rather than waiting for the due date. A simple calendar reminder can make a big difference. Start by finding the closing date for each of your credit cards. This information is usually hidden inside your previous statements. Look for phrases like billing cycle ends or statement closing date. That is the day the bank finalizes the balance that will be reported to the credit bureaus. After you identify that date, set a reminder 2 or 3 days earlier. When the reminder appears, log into your account and check your current balance. If the balance is higher than you want reported, make a payment that reduces it significantly before the statement is generated. For example, imagine your balance is $800 a few days before the cycle ends. If your goal is to report only $10, you would send a payment of $790 right away. By the time the statement closes, the system will see a balance of about $10 instead of $800. That small number becomes the figure reported to the credit bureaus. Your utilization percentage now appears extremely low, even though you used the card normally during the month. After the statement is issued, you still have plenty of time before the due date arrives. At that point, you simply pay the remaining amount and clear the balance completely, avoiding any interest charges. There is another important detail that many people overlook: the way credit utilization works across multiple cards. Scoring models don't just look at your overall utilization across all accounts. They also check the utilization on each individual card. This means even if your total utilization is low, having one card maxed out can hurt your score. The system sees that single account as a potential risk. To manage this, many experts recommend a method sometimes called all zero except one. Essentially, you pay down most of your cards to zero before the statement closes and leave a tiny balance, maybe 1 or 2%, on just a single card. This shows the credit bureaus that you are actively using credit, but doing so responsibly. The rest of your cards remain inactive, which avoids any red flags. It's important to note that this strategy doesn't require carrying debt past the due date. The small reported balance is fully paid off before any interest accrues. Reporting a balance is simply a way to communicate activity to the credit bureaus, not a requirement to incur interest. This subtle distinction is what separates savvy credit users from the average borrower. Another trap to avoid is relying solely on autopay. While autopay ensures you never miss a payment, it typically pays the statement balance on the due date, which is often too late to control what is reported. To optimize your score, you need to manually intervene a few days before the statement closes. By doing this, you determine exactly what balance the bureaus see, rather than letting the system report a high utilization unexpectedly. Finally, consistency matters. You don't need to micromanage every card every month unless you are preparing for a major loan application. Simply maintaining low utilization naturally keeps your score healthy. But when timing and precision matter, controlling the statement snapshot is one of the fastest ways to influence your credit score positively. Before we wrap up, there are a few final considerations that separate good credit management from truly optimized credit. First, never close old credit cards just to simplify your accounts. Each card contributes to your total available credit. Closing a card reduces your overall limit, which can spike your utilization percentage even if your balances remain the same. Keep old accounts open and occasionally use them for small recurring charges, like streaming subscriptions, to maintain activity. Next, avoid excessive credit cycling. This is when you repeatedly max out a card and pay it down within the same billing period to artificially show lower utilization. While it might seem clever, banks can view this behavior as risky or even suspicious. It can trigger account reviews or, in extreme cases, account closures. Instead, if you need more spending room, request a higher credit limit. Banks usually reward responsible borrowers with increased limits, which makes utilization easier to manage naturally. It's also worth mentioning the evolution of scoring models. Traditional models, like FICO 8, primarily rely on snapshot balances. Newer models, like FICO 10T, analyze trends over months. Even if you control your statement balance carefully, these trend-based systems can detect patterns of high usage followed by last-minute payoffs. While FICO 10T adoption is not universal yet, it's wise to keep this in mind for the future. The ultimate takeaway is simple. The due date is important to avoid fees, but the statement closing date determines what the bureaus see. By paying down balances a few days early, leaving a tiny reported balance, and keeping overall utilization low, you maximize your score without carrying unnecessary debt. 1 month of careful timing can make a measurable difference. Take control of the snapshot, not just your bank account. With awareness and small adjustments, you stop being a passive observer and start actively managing how the algorithm perceives you. Try this method on a single card for a month. Watch your monitoring app and see how powerful timing and utilization can be for your credit health.